whatever your earnings is. If you can make the right investment at right time, then there is a very good chance that you will become wealthy in the next few years. So let's see a few ways you can invest and see the risk and return involved with each of these investments. The oldest way of investment which still prevails is the gold investment. Gold investment returns vary on how you are investing in gold. If you are buying jewelry, then there will be making charges involved, and the charges will range between 6 to 14% of the gold cost. You can get good returns if the gold is bought in the form of coins or in the form of gold bonds. If you are looking to buy gold with the sole intention of investment, then the best way is to buy is in the form of sovereign gold bonds. Bonds are much safer compared to possessing physical gold, and the bonds will also bear interest rate of 2.5% per annum. Gold investment is hedged against inflation, and historically the returns on gold investment is in power with the rate of inflation. The volatility involved in gold market is low, and hence making it a low risk investment. You can buy gold bonds through post office or banks. The next form of investment is fixed deposit. A fixed deposit is a popular choice of investment in India for decades. The interest rates are attractive and they range from 6.5% to 7% for regular account holders and can go up to 8.6% for senior citizens if they invest under Senior Citizen Savings Scheme. The return fetched by FD are always low compared to the rate of inflation, but at the same time the risk involved is zero, making it a preferred investment option for many. As per the need, one can opt for monthly, quarterly, half-yearly, yearly or cumulative interest option. One can make fixed deposit in post office or in banks. The next form of investment is the stock market. It is one of the highest yielding options available currently, and the average returns vary from 16 to 18%. Even though the money is not locked for any fixed number of years, historically people making long-term investment have earned higher returns. The stock market returns have outperformed inflation. But the stock market is not a cup of tea for everyone. One should study the market before investing, as the risk of losing a considerable portion of capital is high. One will need Demat account to invest in stock market. Next available option for investment is mutual funds. Mutual fund return vary from 12 to 18% depending upon the tenure and the fund type chosen. Again, mutual fund return rates have historically outperformed inflation rate. Many funds have a combination of higher, medium and low risk stocks and bonds, making it an ideal option for people who are looking for more returns compared to fixed deposit but are not ready to take the risk involved in the stocks. Mutual funds in India are regulated by Securities and Exchange Board of India, that is SEBI. So these funds are safe to invest. Mutual fund could be brought through a registered mutual fund advisor, registered online website, or directly through Demat account or even through banks. Real estate is the next type of investment. As we all know, the location of the property is the single most important factor that will determine the value of your property and also the rental income that it can earn. One can get up to 3% of returns if the property is given to rent. The property appreciation have always been in sync with the inflation rate. The volatility in the real estate market is low, hence making it a low risk investment. You can buy property through brokers or through a person you know. Now you know the risk and return involved in each of this investment. Depending upon your age and financial constraint, see what combination of the investment suits you better. Remember, how much wealth you make will not solely depend upon your earnings and savings, but also it depends upon your investment.